Many federal employees have been moving out of the F fund because they're concerned of the potential for rising interest rates. Should you stay put or follow the crowd? We're going to share some data in this video that might surprise you. In this episode, we will compare historical F fund returns to the federal funds rate. We'll also provide elements that you might also use to compare different types of bond funds, and we will provide suggestions for the future of your F fund allocation. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on your complex and often underutilized benefits. If you've watched a lot of our videos, you probably know we like the F fund in your TSP. And over the last couple of years, there's been a lot of talk of the potential for rising interest rates. And we want to give you the tools necessary so you can make some informed decisions about what you should do with the F fund. Should you buy more? Should you get it out of your portfolio? There's a lot of choices. Before we do that, we really want to educate you a little bit more about what the F fund is, and then also what bonds are versus bond funds, because they do work differently. To get some education on the F fund, we've done a really good video, so check this video out, and it should give you a very good baseline about what the fund is, and then also what it isn't. So now let's talk a little bit more about what a bond is. First off, a bond is a very simple thing. It's a debt instrument, sort of like a CD, where you loan your money to the institution, and they give you interest for a set period of time. Bonds generally have an issue date, which is the start date, a maturity date, which is when it ends, and they'll have a coupon rate, which is the interest that you earn. So every bond will have this on the different things. When you're looking at a bond fund, because it's a collection of bonds, you do not have a start or an end date, and you also don't have a set interest rate. Bond funds, because they're a collection, can diversify away from some of the risks that you have with different types of maturities, different types of qualities, and also different types of interest rates. So when you're looking at the comparison between a bond and a bond fund, they are completely different vehicles, even though they use the same underlying value or the underlying investment of a bond. Both bonds and bond funds do have certain risks with them. One of them, and the one that we're going to be talking about today, is interest rate risk. Now, I know what it is, but I want to get it specific, so I went to Investopedia and got this definition: the potential for investment losses that result from a change in interest rates. So it's basically saying when interest rates go up and down, it will affect the prices of the bond or the bond fund. Let's use an example to really explain this. Let's say Susan buys a $10,000 bond, and the bond lasts for 30 years, and it's at a 3% interest rate. What this means is Susan will get $300 a year, 3% of the $10,000, for 30 years. At the end of the time, when the bond matures, Susan would get her $10,000 back. With interest rate risk, interest rates go up, and in this example, go from 3% to 4%. The new bonds that are issued, and again, they have to be the same quality because you want to be comparable, the new bonds at a 4% would give out $400 of interest per year, which is obviously better than the $300 that Susan's getting, which means that Susan's bond is less valuable than the new bond issue. But even though Susan's bond is less valuable, she will still get the $300 a year until the bond matures. And then when her bonds mature, she will get $10,000 back. So even if the price fluctuates while she owns it, she's still going to get her $10,000 or her original investment back, as long as there's no problem with the issuer, either the company or the government. As long as they're still in business or they're still running, she will be able to get her money back. There are bonds that go into default, and that's one of the risks you have to be able to look at. With individual bonds, you have the chance that your bond could go in default. In bond funds, you don't necessarily have that risk. So when we're looking at the interest rates and the quality of the bonds, we want to be able to make sure that we're being comparable on these different areas. When you're looking again at the bond funds, because you're diversifying this risk away, there's a lot of benefits from using a bond fund versus a bond. Now, there are also benefits of using a bond, but we don't want to get too much into that today. Now that we have a good baseline of what a bond and bond fund is and how they work, let's take a look at the historical returns of the F fund and also look at the historical patterns of what has happened with the federal funds rate. In this first chart, what we are looking at is the F fund and how it has fluctuated on the annual returns. Now, this is annual returns, so there's going to be a lot more fluctuations either on a daily or a monthly basis, but we want to be looking at annual so we can actually see patterns. This goes back all the way since inception. So again, since the F fund was introduced into the TSP, this is the whole history. As you can see, there are a lot of ups and a lot of downs. It is not a very flat portfolio, but again, we talked about that in the other video that we mentioned before with the F fund. Now, this chart is the federal funds rate. This comes from FRED, or Federal Reserve Economic Data. It's coming out of the St. Louis Federal Reserve. When you see this, the gray bars are recessions. But what we want to be looking at today is we want to look at the upsides. There have been 5 times in the same period of time that we had for the F fund since inception period that the federal funds rates has increased, and that's what we want to be looking at. What happens when the federal funds rate increases? So you can see the different periods here. It's very important to look. Next, we want to look at the overlay of those same periods of times between the F fund and the federal funds rate. What we see, and we've notated it in green, is when the federal funds rate went up, what happened to the F fund? Very strangely, in those same periods, the F fund went up more times. Sometimes it was the exact same period. Now again, the federal funds rate does actually go more than once a year. It's when it happened, and the F fund is just annual returns. But when we look at those periods of time, the F fund increased in every one of those 5 cycles. This is very important. There might have been a slight dip at the beginning, but they all went up and they all ended up during the end of the increasing of the federal funds rate. The next thing we want to look at is what happened before these increases. And this is the period that we're in right now if the Federal Reserve is going to increase their interest rates. And we're most likely it's going to happen relatively soon. So when we look at this, these 5 periods are those periods. Now, unfortunately, we do not have the period right before the first increase because the F fund wasn't in place at that point. So we're looking at the other 4 and then what's happening right now. And all of these 5 periods, the F fund went down, just like it is right now. This is very important because, as everybody has always told people, that when interest rates rise, bond values go down. This is actually just the exact opposite. When the Fed rates have gone up, the F fund value has gone up. And it's actually the period beforehand that goes down. We have to look at this in a different way. And again, this is just data in one variable we're looking at. But what we have to look at is how does this represent and how does it make an impact for you? If I was looking at this data, I might say the opportunity is when right before the interest rates start rising, not after. And getting out of the F fund now might not be the right time. It might be later on. Now, I don't know which way the F fund is going to go. And to be fair, we're only looking at one bond fund. There are a wide variety of different bond types of funds out there, and some of them may work a little bit more closely to the rising interest rates. But the F fund, and this is what we care about because this is what's in your TSP, the F fund has gone up when interest rose and down before they rose. Let's look at my suggestions of what you should be doing right now with the F fund. And again, I don't know which way the F fund is going to go. I don't know if it's going to go up or don't know if it's going to go down. Nobody does. This is a lot of different variables and factors that play into what any investment goes up and down. What we're trying to show you is one reason to be looking at these variables. So when we're looking at this, if you're proactive, you might want to be buying into the F fund now because you think that because of anticipation of the rising interest rates, the bond prices went down or the F fund price went down, so it might be an opportunity for you. We have to look, though, that because we're looking at one variable, interest rates, we have to look at other variables as well. Some of the other variables you might look at is the quality of the bonds. The F fund is a very good quality of bond, some of the best bonds out there. That will affect different levels. So when you read an article about bonds or bond funds, it might not relate specifically to the F fund because they were talking about maybe different types of quality or the bond market in general. One of the other things you have to look at is the maturity. The longer a bond has to mature, the more volatile a bond will be. The shorter duration or the shorter maturity, the less volatile it's going to be because it's going to mature. And like that example with Susan, she's going to get her $10,000 back. And the closer you are to that, the less risk that's in the bonds. So you have to look at this as another factor that you're looking at. There's a lot of different variables you have to be comparing on this, not just interest rates. So we're just looking at one, so please be careful that you're very knowledgeable about how these work. But again, historical patterns have shown us that if you're buying at the bottom before the interest rates go up, there might be a great opportunity for you here. Again, when I say great, the F fund doesn't have 30, 40% rates of return. They have reasonable rates of return for a bond portfolio, but very low, and then it jumps up during the rise of those interest rates during that period of time. Before you rush to the TSP website to move everything over to the F fund, let's take a quick second to look at some of the variables you really need to consider before you do that. One of them is you want to make sure that the diversity in your TSP matches your long-term needs, or what you need not only in the TSP, but your overall portfolios, what's inside the TSP and what's outside the TSP. If there are some investments that you feel are overpriced, maybe you feel that equity markets have been overpriced or overbought, and you want to reduce some of that exposure you have then, it might be appropriate to move it to the F fund, especially off of some of the things that you learned today. When you're looking at buying the F fund in today's market, you might see that it's on sale because it's cheaper than it was last month or a year ago, and that's a great thing. But again, make sure it's appropriate for you. If you're still watching, hopefully you're liking the content that we're providing, so hit that like button so we know to make more videos just like this. And as always, we want to hear from you, so please put a comment in there for us. There's also a couple of links in the description section of the data that we talked about today. There's a TSP.gov website, which is where we talked about the F fund, or where we got the F fund data from. There's also the FRED data from the Federal Reserve economic data from the St. Louis Reserve. That link is there, and also the Investopedia data link is there as well, so you can read a little bit more about interest rate risk. When we're looking at the different points, we really want to be able to make sure that you're learning from these videos. And two things we really hope you got out of today is that bonds and bond funds are two completely type of vehicles, and they act differently and they have different types of risks. Another thing is that not everything that you hear or you read is going to be accurate. Most people are told that when interest rates rise, bond prices and bond fund prices drop. The data shows differently, specifically when we're looking at the F fund and the Fed funds rates from what we've seen today. Hopefully this has been educational for you. We want the best for you and your family, and please get conflict-free, unbiased advice. Thank you for your time today, and we look forward to educating you in the next video.